Hi everybody, thanks for having me. I'm very much looking forward to presenting here again. It's been a while since I was last at the Festival of Traders. Today I'm going to talk about two simple but effective swing trading strategies for the S&P 500. So if you swing trade or if you trade the S&P, uh, these are concepts that you can easily employ, and I'm going to take it a little bit further than that and show you how to even improve them. But before I do that, let's get the risk disclosure statement out of the way. A lot of what I'm going to show you here is back-tested data, hypothetical results, and anyone that trades knows that there's risk in trading. And just because the market did one thing in the past doesn't mean it's going to do the same thing in the future. That said, I've learned an awful lot in my trading career from back-testing and learning how it's taught me a lot about how the market actually works, and it's helped me greatly. So a little bit about me. You can read this if you want. I've been trading for about 20 years, full time since 2001. I've been published a number of different places over the years. There's just a few of them listed. Presented a lot of different places, and I'm now with InvestQuant. I'm the head of research since 2014 there, and my primary focus with my trading is swing trading. That's where I do most of my trading. I also do some overnight and some intraday strategies as well. So let's talk about two simple but effective swing trading strategies, and what wasn't included in the title is and how to improve them. All right, so I intend to share these as well as how you can make them a little bit better, or substantially better, actually. Oops. Okay. Oh, before I get to that, and this will come at the end as well, but I publish a nightly newsletter, a briefing for InvestQuant, and it uses a lot of the data that we generate in what we call our Swing Edges database. I'll talk a little bit about that later, but you can get a free trial of it. So the letter's been great. We've got a lot of there's a lot of trade ideas that come in the letter. They've been very successful. Clients have done quite well with the letter. It can help you with your market timing, as well as if you want to follow any of the trade ideas. So we'll get to that a little bit later. I'll show you that again. So this is a daily chart of the S&P 500, and it's an old chart. I didn't update this chart, but I thought I would show you a very simple system. And it may look fairly amazing from the results here that you see. Hang on a second, I'm going to pull up my spotlighter so you can follow along. Hopefully everybody can see where I'm pointing with things. But this system bought here, sold there, bought here, sold there, bought here, sold there, bought here, sold up here, bought here, sold up here. So it was a pretty impressive run. It did have a loser at the end here, as you can see. There are losers with this system. Obviously, there are with any system. If there aren't, then it's been over-optimized. But you will soon find out that this system has not been over-optimizing. I'll tell you all the secrets behind it, and I'll show you all the results if you ran it over a longer period of time. Hang on a second. All right, I had to switch the pointer off there. This is what I call my 5-day low, 5-day high strategy. In case you're wondering why it's called that, that's how we get our triggers. The entry rule is incredibly simple. What we're doing is we're looking to buy after a 5-day closing low. So if we look at today's closing price in relation to the previous 4 trading days, and today is the lowest closing price in the group of 5 days, we're going to enter long tomorrow morning, and I'm going to use a limit order equal to today's close, right? So if it gaps up and doesn't close the gap, I'm not getting in. But if I can get an an entry that's as good as today's close, I'm all for it. So on a gap down, I'm in. On a gap up that pulls back to yesterday's closing price, I'm in. All right, so most of the time, you will get in on these trades. You will miss a few from time to time, or miss a few entries. But that's how the entry rule works. It's not a simple market order, it's a limit order that we use. All right, the exit. Look at today's closing price in relation to the previous 4 trading days. If it's the highest price in the group of 5 days, exit at the close. All right, so I do that with a limit on close order. So I will set, I can set my order as early as the market open, right? Because I know what the highest close of the last 4 days was. If we close at or above that level, then I want to get out at the close today, so I can go in and set a limit on close order at the open of trading, or any time after that up until a few minutes before the close when I stop taking them. So all this whole system can be done within a few minutes each day. Very easy. All right, you say, wow, that's pretty simple. Let me show you an example here. So here we have a 5-day closing low occurred actually at number 2 here. All right, bar number 2. Bar number 3, we got in at the open. We got the gap down. It didn't gap up. So we got a better price there. And then we held on to that until the close of bar 5 here. And the close on bar 5 was the highest close of any of these 4 bars. So going into day 5, as soon as day 5 opened, you knew that if it closed above day 1's close here, you're going to be out at the close. And it closed below here, and we'd hold another day and then look to get out at what the then current 5-day high would be. Okay, so now that you understand the rules, hopefully, simply enter right after a 5-day low, get in after a 5-day high. Question is, what about the 4x where you don't see gaps? This isn't designed as a 4x system. This is designed for the S&P. I personally don't trade 4x, so I don't know if this would work on 4x. The S&P is a great index to trade if you're looking at mean reversion type systems, and that's basically what this is. We're looking at sell when it pulls back, and when it reverts back upwards, we're looking to get out. All right. Oops. Now you understand the rules. Let's look at the results. So this is going back a little over 10 years, and what we see here is that there have been 170 trades over that time period. 71% of them would have been profitable. Total net profit, if you're doing 100,000 per trade, would be $63,000. And a profit factor of 1.5. Now, a profit factor basically just takes your gross profit and divides it by your gross loss. All right? So if you had a gross profit of, so it's 179 divided by 115, basically. That's where you get the 1.55 there. I'll also know that you're in the market for about 1,003 days out of this 10-year period. All right, so there's a lot of time spent when you were not in the market. Here's a profit curve. As you can see, it did hit a little hiccup here, but generally, it's persisted higher over a long period of time, and that's a pretty good thing. Now, this is a this is as simple as it gets as far as systems go. You hit a 5-day low, look to enter. 5-day high, look to exit. All right. And it's just one example of how the S&P tends to oscillate. You don't necessarily have to use a 5-day high or a 5-day low, but this is a very simple but effective way to trade the S&P. I'm also going to show you a very simple seasonal strategy. Now, one seasonal characteristic that's been documented, not just by me, but by many people over the years, is that we do tend to get some strong seasonality at the end and the very beginning of a new month. So the end of a month and then the very beginning of the next month. And a few years ago, I came up with this very simple seasonal strategy, and it has continued to impress. So I'm going to share it with you here. You'll know all the rules. And here they are. Today is, for the setup, today is the first trading day after the 24th of the month. All right, so in this case, you're looking at the 24th fell on a Monday. If today is the first trading day after it, that means it's Tuesday the 25th. We're going to buy SPY at the open tomorrow. So that'll be the open of the 26th. All right, now if the 24th happened to fall on a weekend, say it was a Saturday, Sunday would be the 25th, Monday would be the 26th, that would be the first trading day after the 24th. So you'd be buying the open of the 27th in that case. All right, so whatever the first trading day is after the 24th of the month, you want to look to buy tomorrow at the open. And then you're going to exit at the close of the first trading day of the next month. So you're going to hold, in this case, from the 26th through the 1st. But again, if the 1st fell on a weekend, then you'd be selling on the 2nd or the 3rd. All right? Pretty simple. There's no other filters in this. Let's take a look at the results. Today's the first trading day up to the 24th of the month. Again, I'm going back to 2007 for these. And what we see is it's got an impressive profit factor here of 1.4. Nearly 60% of the trades have been profitable. And it's got $33,000 in gains. These do include commissions, these results as well, as did the previous ones. Your average trade makes about 1/4%. So each month you're making about 1/4% on those trades. That's pretty impressive, right? Not a ton if you're just using SPY, but you can use leverage ETFs. You can take advantage of this tendency with options or futures or what have you. So that is a very simple and effective seasonal technique. Here's a profit curve. Not quite as pretty as the last one. It chops around a bit, but it chops higher, right? It's been going in the right direction, generally, for 10 years. So that's a good thing, and we know now how the market works around month ends. So this is one of those things where you keep trading it until eventually, perhaps someday, this curve starts heading lower, and then you can adjust the system if need be. All right, so they're nice, but how do we improve them? I'm going to talk to you now about some concepts that I've used in my trading that I've also incorporated into InvestiQuant's swing edges data. And there's 3 concepts that I'm going to talk about. One is acceleration. And acceleration basically is how fast is the market moving, and we also look at where's that movement coming from. So here we see we've got a strong sell-off coming after a sideways consolidation. Right? If we had a strong move lower after a move up, that might mean something. That would mean something different. If we have a strong, steady downtrend followed by an acceleration downwards, that would contain a different meaning. All right. So we measure acceleration, or we use the acceleration concept in some of the systems that we use to evaluate the market. Momentum looks at persistency. So in this case, we're looking at how persistent has the move been over the last few days, weeks, etc. How strong is it? And then where is it trading in relation to the long-term trend as well? All right. So momentum is which direction you move in, and how persistent is that movement. And that's an important thing to look at if you're designing a trading system, or if you're looking at how strong a stock or an index even is. Is it trading above its intermediate term moving averages for a long period of time? Is it continuing to hold above its 20-day, its 50-day, even its 10-day? Right? If it is, that's got some good momentum, some good persistency behind it, and you can look to buy dips in things that are showing strong momentum. Seasonality, I showed one seasonality system, but there's a bunch of different seasonal forces that can be in play, and we've got complex seasonality algorithms at InvestQuant, our Swing Edges products, that look at all kinds of different things. So basically, we're really looking to see, how has the market performed during similar periods in the past, and that may be around holidays or different market cycles, or different times of the week, or times of the month, or times of the year. So we look at it a number of different ways for our seasonal products. And I'm going to run through this really quickly, but basically we've got 9 what we call guides, and the Swing Edges are designed to take all of these 3 concepts and look at them over a few different time frames and generate some very simple numbers that can be useful to using as filters in trades. So now I'm going to take the systems I just showed you and say, hey, what if we applied some of these concepts where I'm looking at acceleration, I'm looking at momentum, I'm looking at seasonality, combine them with the 5-day high-low system, and see if we can improve on it some. And so here what I'm doing is I'm saying, all right, SPY closed the 5-day low, and our swing guides. There's 2 important numbers that show up in our swing guides. One's a win rate and the other's profit factor. And a win rate above 55 and a profit factor above 1.3 are considered solidly bullish. They're not extremely bullish. They're not mildly bullish. They're solidly bullish. They're kind of they're in the middle, right? They signal a decent edge. So we get a decent edge, and we get the 5-day low. We're going to buy tomorrow just like we do normally. And in this case, we'll sell when it closes at a 5-day high, or when the Swing Edges data is no longer solidly bullish. In that case, we're running over the same period. What we see is we got higher profit factor, higher net profits, and higher average trade, and less days invested. And I'll show you a comparison of the results. Here's the profit curve, which looks quite a bit straighter than the curve I showed you before. Here's the differences that we're looking at. So without Swing Edges, there was 170 trades where you had the 5-day high low, 5-day low, 5-day high exit. With Swing Edges data incorporated, it narrows it down to 140 trades. So 18% less trades you got to manage. And in fact, the number of the trading days, the number of time that you're exposed to the market is nearly cut in half. Now, if you're cutting your market exposure in half, that's allowing you to trade other strategies. It's also protecting against risk. The less time you have exposure, the less time, when there isn't really an edge, the less time you're exposed to that kind of risk. Profits are actually higher. Not much, but 4% higher with half the days invested. That's pretty good. Average loss is 41% lower, the max drawdown is 30% lower, and the average trades 26% higher. So you got fewer trades, fewer days exposed to the market, more total profits, and smaller losses. Overall, you're looking pretty good. Same thing for the seasonal strategy I showed you. I just want to mix in the Swing Edges data there. And in this case, I'm going to say the data just has to be mildly bullish. I'm not even looking for strongly bullish because I didn't want to filter out too much. So for mildly bullish, we're looking for the standard entry criteria, right? Today's the first day after the 24th of the month. But now we're saying we're showing a win rate of at least 50% and a profit factor of at least 1.1, or we were 1.3 before that we wanted to show an average. So these are mildly bullish numbers. Better than neutral for the most part, right? So in this case, we're going to buy SPY at the open, sell on the close first trading day next month, or the morning after, we're no longer even mildly bullish. If things turn bearish, we're out, okay? And in this case, again, we see total profits go up. We see our profit factor increase. We've got a few less trades here, I believe. The curve looks pretty nice as opposed to the one that was a lot choppier before. And here's a comparison of the two systems. This is our seasonal system without swing edges, and this is the seasonal system with swing edges. About the same number of trades. Some months you didn't have any trades. Some months you might have had 2 trades, right? Where you got in and out a couple times in that 4 or 5 day period because of the fact that the data showed that there wasn't a strong edge. Days invested, 20% reduction. Net profits, 35% increase. That's a big increase in net profits. And your average trade improved, your max drawdown improved. So again, less exposure, less drawdowns, substantially better profits. I have saved enough time. I anticipated saving 5 minutes. I've saved 7 minutes for questions. Let me go back. Oops. Let me go back to the question and answer over here. I'll tell you a little bit about the Swing Navigator while I wait for questions to come in. And this is it looks like I had a few questions come in, so I'm going to try and expand this so I can see them better. And I wish I could do that simply.
Rob, sometimes it's just easier to detach it. If you just grab the top of it, put your mouse on the top, and pull it out to the side. Sometimes you can.
I'm sorry, what am I pulling to the side? The actual.
Well, if you just put your mouse like on top of questions, and then you can detach it from the.
That doesn't seem to be working for me. All right, let me scroll to the top and see what I missed here.
Actually, your questions will be at the very bottom.
What's my MA number? As you said, 15200. The chart shows 10 of 40. That's not me, is it? Name of my wealth management company. It's a private investment partnership. It's Hanna Capital Management is the company I managed since 2001. Why the 24th? That's for me, I'm sure. So in testing, I found that it was those last few days of the month. So the 24th is what turned out to look pretty good and fairly robust. Prior to that, there wasn't much of an edge. Just taking a look at seasonality. Again, this was done several years ago, and it's, as you saw, persisted pretty nicely. So the biggest day in there is the first of the new month. That's the one that's had the strongest upside inclination. And some of that has moved back a little bit. So so some months now you see a run on the last day of the month in the afternoon, and if you get that, sometimes it takes away from the edge of the first day of the next month. But if you don't get that, if you get a sell-off going into the end of the month, then a lot of times you still get that nice bump the new month. And there does tend to be some strong seasonality again after the 24th as well. Simple is the best way, someone commented, and yeah, I completely agree. You really don't need to make super complex systems. What you need is just some basic concepts that work, and it's, you know, the low 5-day high is just an example of many that I've seen over the years and many that I've created. If you're in an uptrend and you're buying pullbacks and getting out on a consistent basis when you get that reversion and not trying to hold on continuously, then you're in good shape. Be patient for the pullback, sell when you get the reversion. S&P 500 E-mini, I was using SPY there. Yeah, you can use the E-mini. You can use you can use leveraged ETFs as well. It's like UPRO is the long 3 times S&P 500. Or if you're an options trader, you can create option strategies around this. As far as the Navigator goes, I'd invite anyone to check it out. It's again, you'll see even on that page. I think we highlight one of our clients who recently had a monumental winning streak and some great success. But he's not alone. We've had a lot of success with our clients. The trades have done pretty phenomenal over the last year and a half or so since the newsletter has been released. I think it was December 2015 we started publishing. And you'll get a 7-day free trial. You get a lot of education with that trial as well, so that what you're reading is better understood. So it comes with some webinars, and you can always ask me questions as well. I'm going to type I'm going to try and type. I guess I didn't get it in there. Oh, type message here. Rob at investaquant.com. That's where you can reach me. Rob at investaquant.com. If you have questions about today's presentation, if you take a Navigator trial and have questions about that, either way. Or if you just have questions in general about trading or other services we offer at InvestQuant, feel free to contact me. Looks like my time is just about up here, so thanks, Dave, and thanks everyone at Tire Shark for having me again. It was a pleasure getting to present, and I look forward to being back sometime in the future.